Factors contributing to defaults and market volatility. Greed and profit motives in lending practices played a significant role in contributing to defaults and market volatility, especially during the 2008 financial crisis. Here's how. Subprime and predatory lending lenders aggressively issued subprime loans to borrowers with poor credit histories, often offering adjustable-rate mortgages, ARMs, with low initial teaser rates that later spiked to unaffordable levels. So what happened here is that once the teaser rate went up, the borrower was not able to pay the rise in the monthly payment. Lender offices flooded with default letters. Predatory lending tactics included misleading loan terms, excessive fees, and high interest rates that set borrowers up for failure. Many lenders disregarded income verification and creditworthiness to maximize loan volume and profits. Lenders can approve a person with poor credit for a loan, but they typically require additional factors to mitigate the risk. Here's how they might approach this. Higher interest rates. Compensate for risk. Lenders charge higher interest rates to borrowers with poor credit to compensate for the higher risk they pose. The higher rate helps to ensure the lender still makes a profit even if the borrower defaults. Larger down payment reduces loan-to-value ratio. A borrower with poor credit may be required to put down a larger down payment. This helps reduce the loan-to-value ratio, LTV, and lowers the lender's risk. Shows commitment. A larger down payment also demonstrates the borrower's commitment to the loan and may provide a safety cushion if the borrower defaults. Co-signer or co-borrower. Additional security. If a borrower has poor credit, a lender may approve the loan if the borrower has a co-signer or co-borrower with good credit. This adds a layer of security for the lender, as they can pursue the co-signer or co-borrower for payment if the borrower defaults. Secured loans. Collateral. A secured loan requires the borrower to provide collateral, like a house or car. In the event of a default, the lender can seize the collateral, reducing their risk. For example, someone with poor credit may be approved for a car loan or home equity loan because the lender can claim the asset if the borrower defaults. Alternative credit scores. Non-traditional scoring. Some lenders use alternative credit data, such as rent payment history, utility bills, and even bank account activity to assess creditworthiness. This can help approve borrowers who may have poor scores but demonstrate financial responsibility in other areas. Subprime loan programs, designed for higher risk. Some lenders specialize in offering subprime loans to borrowers with poor credit. These loans typically come with higher fees and interest rates but provide a path for those with damaged credit to secure financing. Verifying income and job stability. Income verification. Lenders will closely examine the borrower's income, employment history, and debt-to-income ratio, DTI. Even with poor credit, if the borrower has a stable income and low DTI, they may still qualify for a loan. Job stability. If the borrower has been employed with a steady job for a long period, it can make them a more attractive risk to lenders. Secured credit cards or credit builder loans. Building credit. Some lenders may approve a borrower with poor credit for a secured credit card or a credit builder loan. These are designed to help the borrower rebuild their credit history over time. Borrowers can use these tools to improve their credit score and increase the likelihood of getting approved for larger loans in the future. If a person doesn't have any credit history, it can be challenging to get approved for traditional credit products, like credit cards or loans, as lenders typically rely on a credit score to assess the borrower's creditworthiness. However, there are several ways a person can start building credit from scratch. Apply for a secured credit card. How it works. A secured credit card requires a deposit, which acts as collateral. For example, if you deposit $500, your credit limit will be $500. This deposit reduces the lender's risk because they have access to your deposit if you fail to make payments. Building credit. By using the card responsibly, making small purchases, and paying the bill on time, you can build a positive credit history. Reporting. Make sure the issuer reports to the credit bureaus, Experian, TransUnion, Equifax, so that your payment history is tracked. Apply for a credit builder loan. How it works. Some financial institutions, especially credit unions, offer credit builder loans. These loans are designed to help people build credit. How it works. Instead of receiving money up front, the loan funds are held in a savings account or certificate of deposit, CD, until the borrower has paid off the loan. Once the loan is repaid, the borrower gets access to the funds, and the lender reports the on-time payments to the credit bureaus. Impact on credit. Making consistent on-time payments will build a positive credit history. Become an authorized user on someone else's account. How it works. Ask a family member or trusted friend with good credit if they will add you as an authorized user on one of their credit cards. This allows you to inherit their credit history on that account without having to open a new one. Benefits. As an authorized user, you benefit from the account holder's on-time payments, which can help you build credit without using the card yourself. Important. Make sure the account holder has a good payment history and that the card issuer reports authorized user activity to the credit bureaus. Apply for a store credit card. How it works. Store credit cards are often easier to qualify for than major credit cards. These cards are issued by specific retailers, like Walmart or Macy's, and can only be used for purchases at that store or in a store group. Building credit. Use the store card responsibly, keeping your balance low and paying on time, and it can help build your credit history. Use a cosigner. How it works. A cosigner is someone with established credit who agrees to take responsibility for the debt if you fail to make payments. Having a cosigner can increase your chances of being approved for credit, especially if you have no credit history. Risks. Keep in mind that if you miss payments, your cosigner will be held accountable, and it could damage their credit as well as yours. Apply for a peer-to-peer loan. How it works. Peer-to-peer, P2P, lending platforms like Lending Club or Prosper allow individuals to borrow money directly from other individuals, bypassing traditional banks. Building credit. These loans are typically unsecured, and while they may have slightly higher interest rates, making timely payments can help you establish a credit history. Set up utility accounts in your name. How it works. Setting up accounts for utilities, electricity, gas, water, or even your cell phone, in your name can help you build a credit history. Credit reporting. Some utility companies report your payments to the credit bureaus. If they do, paying on time can contribute to your credit profile. Alternative data reporting. Some services like Experian Boost allow you to have utility and phone payments reported to the credit bureaus, which can help improve your score. Try Experian Boost or alternative credit scoring methods. How it works. Some services like Experian Boost allow you to add utility, phone, and streaming payments to your credit report, which can help boost your credit score even if you don't have traditional credit accounts. Impact. This method can help you get credit if you don't have a traditional credit history. Start with a low-cost loan from a credit union. How it works. Many credit unions offer small, low-interest loans to help individuals build credit. These loans are typically easier to get if you're new to credit, and making on-time payments will help build a positive credit history. Additional tip, credit unions often have lower fees and interest rates compared to traditional banks, so they may be a good place to start. Be consistent with payments. Key to building credit. Whether you're using a secured card, a credit builder loan, or becoming an authorized user, the most important factor in building credit is paying your bills on time. Impact. Payment history makes up about 35% of your FICO score, so establishing a track record of on-time payments will significantly boost your creditworthiness. Subprime lenders. Riskier lenders. There are lenders who specialize in offering loans to high-risk borrowers with poor credit. These lenders are more likely to approve the loan, but they often come with much higher interest rates and less favorable terms. Length of credit history. Length versus depth. If the borrower has a long history of poor credit, but with more recent signs of improvement, like consistent payments, lenders might still approve the loan. A long history with occasional missed payments may be seen more favorably than recent, severe credit problems. How it all works together. While a poor credit score is a red flag, lenders weigh many factors beyond just the credit score. A borrower with poor credit but strong income, significant assets, a large down payment, or a cosigner can still get approved for a loan, albeit at a higher cost, in terms of fees, interest rates, etc. Securitization and risky investments. Banks and mortgage lenders bundled risky loans into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, selling them to investors. These financial products were rated AAA by credit rating agencies, despite containing high-risk loans. Lenders had little incentive to ensure borrowers could repay, because they sold the loans to investors instead of holding them. Greedy lending and lack of accountability. Many financial institutions prioritize short-term profits over long-term sustainability, pushing as many loans as possible without regard for repayment risk. The lack of regulatory oversight and conflicts of interest, e.g., rating agencies giving high marks to bad securities, allowed the cycle to continue. Housing bubble and market volatility, easy credit and lax lending fueled a housing price bubble. Home values skyrocketed as more people obtained risky loans. When borrowers couldn't afford their payments due to interest rate resets or job losses, foreclosures spiked, leading to a market collapse. The resulting financial crisis led to bank failures, stock market crashes, and global economic instability. Lessons learned regulations like the Dodd-Frank Act, 2010, were introduced to curb reckless lending. Lending standards have since tightened, but profit-driven motives still influence lending practices, requiring ongoing oversight. Who is supposed to be monitoring these large lenders? In the United States, several regulatory bodies and agencies monitor large banks and financial institutions regarding their lending practices, including loans given to individuals who may not be able to afford them. These agencies enforce laws and regulations designed to protect consumers, ensure fair lending practices, and promote financial stability. The key regulators involved in monitoring and enforcing rules related to lending practices are the Consumer Financial Protection Bureau, CFPB, role. The CFPB is the primary federal agency responsible for overseeing consumer financial products and services. It ensures that banks and lenders follow consumer protection laws and regulations. The CFPB enforces rules related to fair lending, mortgage practices, and the suitability of loans. Key laws enforced. The Truth in Lending Act, TLA, requires lenders to disclose clear information about loan terms and conditions to consumers. The Home Mortgage Disclosure Act, HMDA, ensures that lenders provide data on mortgage lending practices, including loans issued to low-income or minority borrowers. Ability to Repay, ATR, and Qualified Mortgage, QM, rule, ensures that lenders assess a borrower's ability to repay before issuing certain types of loans. The Federal Reserve, the Fed role. The Federal Reserve is responsible for overseeing the stability and safety of the financial system, which includes large banks and lenders. It monitors lending practices and enforces banking regulations that ensure financial institutions operate soundly and do not issue loans that could lead to excessive defaults or financial instability. Key areas of oversight. The Fed conducts stress tests, evaluates capital reserves, and implements monetary policy that influences lending practices, including the requirements for loan underwriting. The Federal Deposit Insurance Corporation, FDIC, role. The FDIC regulates and supervises banks and ensures that they operate in a safe and sound manner. It protects consumers' deposits and monitors lending practices at insured institutions. Key responsibilities. The FDIC enforces rules on fair lending, risk management, and loan loss provisions. It also conducts examinations to ensure that banks are adhering to safe lending practices. The Office of the Comptroller of the Currency, OCC, role. The OCC regulates and supervises national banks and federal savings associations. It is responsible for ensuring that these institutions engage in sound lending practices and comply with federal laws. Key areas of oversight. The OCC monitors lending activities to prevent predatory lending, discriminatory practices, and issuing loans to borrowers who are not creditworthy. The U.S. Department of Housing and Urban Development, CHUD role, SHUD monitors and enforces the Fair Housing Act and Equal Credit Opportunity Act, ECOA, ensuring that banks and lenders do not discriminate against borrowers based on race, ethnicity, gender, or other protected characteristics. Key responsibilities. HUD works to prevent predatory lending practices and to ensure that low-income and minority communities are not unfairly targeted with unaffordable loans. The Federal Trade Commission, FTC role. The FTC enforces consumer protection laws related to unfair or deceptive acts in lending and credit practices. It also monitors practices that may target vulnerable populations with high-risk or unaffordable loans. Key areas of oversight. The FTC works to ensure that lenders and credit card companies do not engage in deceptive or predatory practices that put consumers at risk of unaffordable debt. State regulatory agencies. Role. In addition to federal agencies, each state has its own regulatory agencies that oversee the lending practices of banks and non-bank lenders operating within the state. These agencies enforce state-specific lending laws, such as usury laws, which limit interest rates, and consumer protection laws. Examples: state banking departments, state attorneys. General, they often take action against lenders who engage in unfair lending practices or violate state consumer protection laws. Key regulations and practices to prevent risky loans. Ability to repay, ATR. Rule. Lenders are required to assess a borrower's ability to repay a loan before extending credit, ensuring that borrowers are not overburdened by debt. Qualified Mortgage, QM, rule, establishes standards for loans that are considered qualified and ensures that they are not issued to borrowers who cannot afford them. Consumer protections against predatory lending, laws like the Homeownership and Equity Protection Act, SHWEPA, and Dodd-Frank Wall Street Reform and Consumer Protection Act aim to protect consumers from abusive lending practices and predatory loans. Monitoring and reporting. Regulators require banks to report data about their lending practices to ensure that loans are not being offered to individuals who cannot afford them and that lending is done equitably. How do these agencies monitor lending practices? Examinations and audits. Regulatory agencies regularly examine banks to review their lending practices, compliance with laws, and overall financial health. Consumer complaints. Agencies like the CFPB collect and investigate consumer complaints regarding unfair or discriminatory lending practices. Data collection and analysis. Agencies analyze mortgage and loan data to spot trends that may indicate lenders are issuing unaffordable or high-risk loans. Are there any regulations or deregulations that have occurred recently after the bubble? A significant legislative change was the Economic Growth, Regulatory Relief, and Consumer Protection Act, signed into law in May 2018. This act rolled back key provisions of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which had been established after the 2008 financial crisis to enhance financial oversight. Notably, the new law increased the asset threshold for banks deemed too big to fail from $50 billion to $250 billion, thereby exempting many large banks from stringent regulatory requirements. Critics argue that these deregulatory measures contributed to weaknesses in financial oversight, potentially leading to increased risks within the banking sector. Some experts suggest that reduced regulatory scrutiny may have played a role in subsequent banking challenges.